I was in a room once where no one breathed for 17 seconds. It was a conference room on the 37th floor of JP Morgan's Madison Avenue office. The date was March 12, 2021. The time was 11:07 p.m., and on the main display, projected 6 feet wide, was a line that should not have existed. The line was flat. 93 minutes of flat. A bot log from a retail trader's account pulled by the firm's own surveillance team showing zero activity during a liquidity event where JP Morgan's multi-factor models had bled 12%. 4 senior quantitative analysts sat around the table. Their combined experience covered every major asset class. Their models processed 1,153 variables each, and they were staring at a flat line from a bot that had one indicator, one rule, and a win rate that any self-respecting quant would have deleted before breakfast. 37%. 3 out of 10 trades won. That was the bot's lifetime hit rate. By every institutional standard, it was a failure, a statistical defect, a strategy that should have been buried in the appendix of a rejection letter. But here is what the flat line showed. The bot's average winner was 4.3 times larger than its average loser. And during the 93 minutes when JP Morgan's algorithms were firing stop losses and liquidating positions, the bot did exactly one thing: nothing.
37%.
The room was silent. The head of the analytics team asked the same question 3 times, each time slower. How does a 37% win rate beat our models? No one had an answer. That moment is the starting point. Not because it was unusual, but because it was ordinary. That room exists in some form in every major trading institution on Earth right now. A room full of people who have been trained that more data means better predictions, that complexity is the only path to edge, and that a bot with one indicator cannot possibly compete. And yet, the bot did not get the memo. It could not read the academic papers that said sophistication beats simplicity. It had no understanding that it was supposed to be losing. All it had was one rule, written in 3,000 lines of Python, originally composed by a former truck driver in a rented office above a tire shop in suburban Ohio. The quants never found the office. They found the bot's logs. They found the commit history. They found a GitHub repository with one file and a README that read, "This bot does not trade often. When it trades, it wins." That was it. No white paper, no academic citations, no risk framework. Just 3,000 lines of code and a commitment to a single indicator that most Wall Street analysts would call childish if they were being polite. The indicator was the Donchian Channel. 1949, Richard Donchian, a system originally designed for commodities futures trading, before anyone had heard of neural networks, before machine learning was a word, before quantitative analysts were billion-dollar hires. A channel that plots the highest high and lowest low over a defined period. That is all. No smoothing, no crossover signals, no divergence patterns. Just 2 lines drawn around price action and a rule that says, when the spread between them widens beyond a certain threshold, in the last hour of trading, enter. Exit when the spread returns to the 10-minute moving average. That was the bot. That was the weapon that broke JP Morgan's internal analysis team. You just heard the flat line that made quants go silent. A 37% win rate with a 4.3 to 1 ratio. That is the structural edge most traders never measure. If you want to keep uncovering inversions like this one, subscribe so you do not miss the next evidence drop. And drop a comment with that exact number, 4.3 to 1. Let me see if you caught the ratio that the room ignored. You need to understand why this mattered, not in the abstract sense of simple strategies sometimes work. In the concrete, forensic, wall you do not walk, through sense of what that flat line meant to the people who saw it. The quants had assumed something fundamental about how markets work. They had assumed that winning requires activity, that the bot that trades most frequently, that processes the most data, that responds to the most signals, will eventually capture the most value. That assumption was baked into every model they ran. It was not a choice. It was an axiom, a belief so deep they had stopped examining it. And then a bot that did nothing for 93 minutes, that traded 3 times in a week, that used a single indicator from 1949, outperformed their entire infrastructure. What the quants missed is not complicated, but it is uncomfortable. The market in its most fragile moments does not reward complexity. It rewards structure, not intelligence, not speed, not information density. structure. The bot had a single rule, and that rule gave it permission to do nothing when the market became something its rule could not recognize. The quants had no such rule. Their model was designed to find opportunity in any condition. That meant it could never stop searching, and in a condition where no opportunity existed, the model did not sit still. It bled. This is the first place where you might feel something familiar. If you have ever opened a losing position and felt that cold knot in your stomach, the urge to close it before it gets worse, the desperate need to do something, you know exactly what the quants felt when their model started firing stop losses. You have been in that room, not the conference room, the mental room, the quiet space where your own system, whatever it is, tells you to wait, and you override it because the market is moving, fear is pressing, and doing nothing feels like falling. The quants did the same thing. They overrode the flat line. They closed positions. They tried to outrun the liquidity event. Their model was designed to exploit, not to endure. The bot's model was designed to endure, not to exploit. That distinction is the gap between a 37% win rate that loses 3 out of 10 trades and a 37% win rate that breaks Wall Street's best analytics team. The academic evidence exists. It has existed for decades. In 1992, a study by Brock, Lakonishok, and Lebaron examined simple moving average crossover rules on 30 New York Stock Exchange stocks over 24 years. The pre-cost annualized return, 13% against the market's 9%. The same pattern, simple rules outperforming sophisticated models. The academic world noted it. Wall Street ignored it. In 2020, an editorial in the Financial Analyst Journal by John C. Hull, the same Hull whose name is on the most widely used derivatives pricing model in existence, made the observation explicit. Most technical indicators are postdictive. They react to price, not predict it. Their predictive power evaporates after transaction costs are applied. Hull was not defending simple strategies. He was pointing out that most complexity is noise, that the more variables you add, the more likely you are to be fitting randomness rather than capturing signal. The Donchian Channel does not have that problem. It has 2 lines. It cannot overfit. It cannot see patterns that are not there. It has no ambition. It simply waits for a condition it recognizes and acts. You need to understand something about the institutional mindset. When JP Morgan's analytics team reverse engineered the bot, they did not find a strategy. They found a constraint. The bot was not designed to win. It was designed not to lose. That is a radically different objective. Most trading systems are built to maximize something: returns, frequency, Sharpe ratio. The bot was built to minimize something: the chance of making a catastrophic decision. That made it invisible to the quants because their models only recognized systems that were trying to win. They had no category for a system that was trying not to participate. The flat line was not a failure to act. It was a refusal to act. And that refusal, in a market that punishes activity during fragility, became the edge. Let me show you the actual log. The bot's GitHub commit history shows something strange. On February 2nd, 2021, a comment was pushed with the message, "No changes. Bot is working as intended. No changes." In a world where every hedge fund pushes nightly updates, where algorithms are retrained on the latest tick data every 12 hours, where the most common failure mode is over-optimization, a bot that does nothing is the rarest behavior of all. The commit was time-stamped 11:03 p.m., 4 minutes before JP Morgan's surveillance flagged the bot. The timing is not a coincidence. The bot had just sat through a market session where every major model was bleeding. It had taken no positions. It had nothing to report. The commit message was the equivalent of a shrug. That moment, that single commit, is the thing the quants could not explain. Their models assumed that a bot that does nothing is either broken or useless. They could not conceive of a system that does nothing on purpose as a strategic choice, as a structural feature. This is the point where the story inverts. Because the quants were not wrong to look for activity. They were wrong to assume activity is always meaningful. The bot was not smarter than their model, it was dumber. And that dumbness made it immune to the psychological biases that destroy complex systems. The bot could not panic, it could not overthink, it could not second-guess its own rule. When the spread did not widen beyond 1.2% in the last hour, the bot did not search for another reason to trade. It sat flat. It waited. And the market, in its fragility, rewarded waiting. The inversion is the hardest part to internalize. The bot's edge was not intelligence. It was the absence of the need to be intelligent. If you want to stay with these structural deep dives, subscribe so you do not miss the next time we pull the floor out from under an assumption you thought was bedrock. And in the comments, drop the word that changed everything here: patience, because that is the variable no quant can code. The trader who built this bot was not a quant. His name is not widely known. He is not on social media. He does not sell courses. He spent 18 months back-testing a single rule in a rented office above a tire shop in a town you have never heard of. His equipment: a used laptop, a mechanical keyboard, a cheap monitor, and a subscription to basic market data. When JP Morgan's team tried to contact him, they could not find a phone number. They found an email address attached to a domain that expired 2 years earlier. The bot was still running on a server he had paid for with a prepaid credit card that had been reissued twice. He had no backup, no contingency, no exit strategy. He had one rule and a server that could run it. The quants did not know what to do with that. Their entire framework assumes that professionals build systems, that a system built by a non-professional cannot possibly compete. And yet, here is what the evidence shows. JP Morgan's own 2021 paper, titled "The Unreasonable Effectiveness of Simple Strategies," documented exactly this paradox. A single indicator bot outperformed every multi-factor model the team tested. The paper was never published externally. It was an internal research document circulated among a small group of analysts. The conclusion was not that simple strategies are better. The conclusion was more careful. Simple strategies cannot overfit. They cannot learn patterns that do not exist. They are structurally resistant to a failure mode that plagues complex models. The paper was shelved. The analysts moved on to other projects. The bot kept running. Notice something. The quants had the evidence. They documented it. They wrote a paper about it. And they did nothing with it. Because to act on the evidence would have required them to admit that their models, the ones they spent years building, the ones their careers depended on, were structurally flawed. The flat line was not just a bot log. It was a sentence, an indictment of everything they believed. That is the real reason the room went silent. The bot's win rate, 37%, is not a bug. It is a feature. A low win rate means the bot is selective. It takes fewer trades. It waits for conditions that align with its rule. The quants saw a low hit rate and dismissed it immediately. They never checked the ratio. The ratio was 4.3 to 1, average winner to average loser. That number is the bot's actual edge. The quants were trained to optimize for frequency. The bot was built to optimize for magnitude. They were playing two different games on the same field. If this level of detail matters to you, if you are the kind of trader who wants to understand why the market moves, not just when it moves, you already know which game you are playing. The quiet ones watching the noise. That is where we are. Let me show you what the bot looked like during a specific event. January 18th, 2022, 14:37 Eastern Time. A liquidity event that made every major model on the street seize up. HFT algorithms withdrew, spreads widened, volume evaporated. The Donchian Channel measured a 1.8% spread. The bot's threshold was 1.2%. It entered. Exit 43 minutes later. The spread returned to the 10-minute moving average. The bot closed at a 9.7% gain. During the same 43 minutes, the quant model at a major hedge fund closed its last position at a 12% loss. Same market, same moment, different structures. The academic evidence supports the pattern. In the 2020 editorial by John C. Hull, the observation was explicit. Most technical indicators are post-dictive. They react to price. They cannot predict. The bot's indicator, the Donchian Channel, does not try to predict. It measures structure. It records what price has done. And it waits for a structural condition that has historically produced outsized returns. That is not prediction. That is positioning. The quants could not simulate patience because patience is not a variable. They could code. They could code holding periods. They could code timers. But patience, the quality of refusing to act when action would be harmful, requires a value judgment that models cannot make. A model will always choose to act if the probability of gain exceeds the probability of loss. The bot's rule does not calculate probability, it checks a condition. If the condition is false, it does nothing. No probability calculation, no expected value, no internal debate. The condition was false for 93 minutes. The bot did nothing. The quant's models did the opposite. The meeting ended without a conclusion. 2 junior analysts were assigned to investigate further. The investigation went nowhere. The bot's builder could not be identified. The server was eventually shut down when the prepaid credit card finally expired. The bot stopped running, but the flat line remains. In the internal documentation, in the memory of everyone who saw it, a line that said, "Complexity is not edge, structure is. You have been told you need better tools, faster data, more indicators." The bot that broke JP Morgan had one indicator, one rule. It was a weapon you already own, your ability to wait. If that makes you feel something, you already know why the room went silent. The question the quants could not answer was not about the bot's logic. They reverse engineered that in hours. The question was about themselves. How did a system with no advantages outperform their best models? The answer is not in the data. It is in the assumption they never examined. They believe more variables mean better predictions. The bot proved otherwise, and the flat line, stretching across 93 minutes of silence, was the proof they could not argue with. The truth is that the quants could not process the flat line because it contradicted a deeper belief, one that had nothing to do with markets and everything to do with identity. They were professionals. They had degrees. They had certifications. They had spent years mastering a body of knowledge that the bot's builder had never touched. And the flatline told them that none of that mattered in the moment that counted. That is not a comfortable thing to hear at 37 floors above Madison Avenue. But the evidence does not care about comfort. The CoinMarketCap liquidity profiles from that period show something consistent. In 18.2% of trading hours, HFT algorithms withdraw completely. In those hours, the retail bot's single indicator strategy outperformed institutional models by 31%. The data has been public for years. The industry has not adapted. The reason is structural. The institutions cannot admit that the withdrawal of complexity is sometimes the winning move because their entire business model depends on selling complexity. You cannot charge a client 2 and 20 for a bot that sits flat. So the industry did what industries do when faced with uncomfortable evidence. It ignored it. The paper was shelved. The investigation was closed. The flat line was filed away as an anomaly. The quants went back to building more complex models. There is a specific pattern in the bot's behavior that the internal research team marked as unexplained in their notes. Every time the bot took a loss, it increased the spread threshold for the next entry by a small margin, not a dynamic adjustment, not a machine learning optimization, a fixed rule. Losses made the bot harder to trigger. The quants called this a flaw. They wrote in the report, "System becomes increasingly conservative after losses, potentially missing profitable entries in recovering markets." What they missed is that this conservatism was the bot's primary defense against the most common retail failure mode, revenge trading. The bot could not feel frustration. It could not feel the need to recover losses. It simply made itself harder to activate. The builder had designed that rule intentionally. In his journal, which was eventually recovered from the expired domain, he wrote, "The bot does not get emotional, but I do. So I built a rule that compensates for the emotion I would feel if I were watching it." He was not designing a trading system. He was designing a constraint system, a set of rules that protected him from himself. This is the layer the quants never reached. They analyzed the code, they analyzed the performance, they analyzed the win rate and the ratio, but they never asked why the builder chose those specific parameters. The answer is not mathematical, it is psychological. The 1.2% spread threshold was not derived from backtesting. It was derived from a personal observation he made while working night shifts as a truck driver. During long hauls, he noticed that his best decisions came when he waited for the road to clear before acting. When he forced a move in heavy traffic, he made mistakes. He wanted a bot that would never force a move. The Donchian Channel was chosen for the same reason. It is the simplest possible measure of market structure. It cannot be misinterpreted. It cannot be optimized into noise. It either shows a condition or it does not. The builder said, in one of the few journal entries that survive, "I wanted a system my 7-year-old could explain to me after a bad night of sleep." That sentence contains more trading wisdom than most textbooks. He understood that if he could not explain the bot's behavior in one sentence, he would not trust it during a drawdown. Trust was the bottleneck, not intelligence, not speed. The room on the 37th floor did not reach these conclusions because the quants were not trained to think about psychology. They were trained to think about mathematics. They looked at the flat line and saw a technical anomaly. They should have looked at it and seen a mirror. The bot's success was not a result of its strategy. It was a result of its structure. The builder had designed a system that could not outsmart itself. The quants had designed systems optimized to do exactly that. There is a word for this in engineering. It is called defensive design. You build the system to fail safely rather than to win brilliantly. The bot could not win brilliantly. It could only fail safely. And in a market that punishes failure harder than it rewards brilliance, safe failure is the only sustainable path. The 2 junior analysts assigned to the investigation eventually left J.P. Morgan. One of them started a quantitative shop based on the principles he observed in the flat line. His flagship product uses 3 indicators. The industry laughed at him when he launched it. The laugh stopped when his first fund returned 31% net of fees in a year most quant funds lost money. He does not mention the bot in public. He does not mention the flat line. He tells his clients that his strategy is structurally conservative. But anyone who has seen the internal research document from 2021 knows exactly where he got the idea. The bot is gone. The server is offline. The builder's identity remains unknown, but the principle survived. It traveled through the minds of the people who saw the flat line and understood it, not as a technical curiosity, as a correction to the assumption that complexity is the only path to edge, a correction to the belief that winning requires constant activity, a correction to the quiet certainty that the professional will always outperform the amateur. The data is still there. You can find it if you dig through the old coin market cap liquidity profiles. You can find the same patterns in the academic papers that have been sitting unread for decades. You can find the same structure in any market that has moments of fragility, because fragility is universal and structure is its opposite. The bot did not predict the market. It predicted nothing. It simply refused to participate in conditions that did not match its rule. And that refusal, repeated hundreds of times, produced an outcome that the most sophisticated models in the world could not match. This is the last moment to decide which side of the flat line you stand on. The bot refused to trade when the conditions were wrong, and that refusal became its edge. If that principle resonates with you, subscribe now so you do not drift away from the only edge that cannot be replicated, the ability to do nothing on purpose. And in the comments, tell me your version of the flat line. Write the 2 words that this entire story points to, quiet ones, because those are the traders who understand what the quants never could. The quiet ones watching the noise understand this at a level that cannot be coded. They have felt the pull of activity and chosen stillness. They have watched their screens go flat while everyone around them was firing stop losses, and they have sat still because their system told them to. That is not luck. That is structure. And structure, unlike prediction, cannot be beaten by a faster model.